Hi everyone, JJ here with The Art of Value. Welcome. Well, today we're going to look at a talk by Mohnish Pabrai about stock market bubbles. It's just been put online recently, but it's from 2015, so it's interesting to see what he said back then comparing to what's happened since. It's about an hour and a half long. I listened to it all and summarized it, so let's get into what he said about bubbles to see if we can pull out some gems from in there. Mohnish starts off with what he calls the motors bubble, and we're going back to the early 1920s here, 100 years ago, when there were hundreds of car companies starting up. The combustion engine car was just getting going, and there was growing numbers of cars, but from a very low base in the low millions. This reminds me of the EV market just a few years ago and what it's like today. So in the early 1920s, there were hundreds of car companies in the US, but as he points out, not many of them made it. As we know, there are only a few car companies 100 years later and even way before that. Mohnish points out that 1921 to 22, the market grew 50%. The number of cars grew 50%. And if you were an investor back then, you might have thought, hey, this is going to work out really well for me as an investor. I need to get into this, because if you see a market growing 50% or more sometimes, then that's a good situation. We can think of the EV market. People got very excited about EVs. I'd say in 2020, there were new car companies, new EV companies, SPACs starting up, new IPOs of EV companies, and everybody thought this was going to be easy money because the number of EVs was growing exponentially in terms of percentages and from a small base, just like combustion engine cars were. But of course, it didn't work out like that. And this is what Mohnish points out, that in 1921, if you saw the situation, the macro situation, that the car industry was growing, this new industry, that it was going to grow, and it did grow. The people were right about that. They were right about the trend, but he said most investors, nearly all investors, lost money in that bubble over time, even though they were right about the trend. And that can happen in a bubble. It can be a grain of truth that starts the bubble. So you can be right about the direction of the trend and even what's going to happen in terms of numbers and still not make money. You can still lose all your money in a bubble situation. There were literally hundreds of car companies making cars, and people thought that many of them were going to survive. This was going to be this great industry with lots of companies. But of course, capitalism doesn't work like that. Not many survived at all. Very, very few, just a handful. And over time, less and less as things consolidated and companies went bankrupt. That's the way that capitalism seems to work, where as companies get bigger and industries get bigger, and even those people who were early on didn't make money. A lot of them, most of them didn't make money. Next, Mohnish turns to the Tronics Bubble, of course, electronics from 1959 to 62, which was 38 years after that other bubble burst, the previous bubble. There was another bubble when electronics was coming along, and people got very excited about that. It was a very innovative industry. Mohnish points out that the expectation back then for electronics, semiconductors, and miniaturization of electronics was going to be a huge thing. It was going to change the world. It's going to be amazing. And the fact was that did happen. It's true. If we look to now, he was giving this talk in 2015, so he points it to there, but it's kept on going since then. And now we've got the AI boom. Some people say a bubble that's forming, but back then it did change the world. If you look at over the long term, from then till now, it definitely changed the world. There's so many things, from smartphones to computers to many things that didn't exist back then. So again, the direction and the trend was absolutely correct. But guess what happened? Not a lot of people made money in that initial innovation boom that happened because people got too exuberant again. It formed a bubble. Back in that initial phase of innovation and the boom and the bubble, a lot of companies were formed that were Onyx or Tron at the end of them. And later on, which Mohnish talks about, so the Dotcom Bubble was all .com. And now we have AI companies that have nothing to do with AI seeming to claim something. And of course, blockchain, if you added blockchain to that a few years ago, there are so many examples of this. But back then it was Tron and Onyx to do with electronics. And some companies even put both of those in the same name. And of course, what happened is the vast majority, nearly all of these companies went out of business, did badly, and people invested in them and lost all their money in this initial hype cycle, we could call it. And then Mohnish comes to the dot-com bubble from 1997 to 2000. About 40 years later, after that previous bubble, we have the dot-com bubble, and this is within people's living memory. A lot of people's, if you're 45 and older, you definitely remember it. If you're younger than that, perhaps not so much. If you weren't involved in the market, you might have been aware of the internet starting. People got interested in the internet. It was a popular phenomenon, started to be in the movies, and people in general use as broadband spread around in those early 2000s. But leading up to that in the 1990s, there was a lot of hype, and a similar thing happened. There were so many companies formed, starting from Netscape on. There were a lot of companies that added a .com to their name, had a business model that they were going to be big online and e-commerce and streaming, and all these things came true. As Mohnish points out, the direction was correct. It was absolutely correct. We've got the biggest tech companies today are internet companies or involved in the internet, but there was this innovation hype cycle that happened, and it went so big this time. It was one of the biggest bubbles in history. When you look back on it, it was a huge bubble. It didn't affect the economy hugely because it wasn't embedded in the economy that much. A lot of those companies went bankrupt, went bust, and disappeared. A very few survived that we know today. Mohnish has talked about Microsoft being in a bubble back then, a $600 billion valuation. And then it went down as the bubble burst, and the valuation didn't get back to there for over a decade. And the same with Amazon. It took over a decade. I'll put a link to that video at the end of this video and in the description as well for those not on YouTube. So Mohnish points out it's the same thing as the Tronics Bubble. People saw that the internet would change people's lives. It was going to reconfigure the economy. There was, at the time, the new economy. The old economy, metrics don't matter. It's all about eyeballs and views. And more than 20 years later, that has come true. If we look at companies like Netflix, which were built on streaming, Google, which is one of the best business models in the history of the world, what they managed to do with targeted ads, and Amazon, of course, became this huge behemoth of e-commerce. But people got too excited too soon, and most people lost their money, and they didn't stay in there. Even for the winners like Amazon, it's very rare to find somebody who invested back then during the bubble, even before the bubble got going, and kept their shares this long to win big. People got disillusioned after the bubble burst and way down to about 2002 in the depths of the bubble, and then it started to slowly rebuild from there, which is the way that hype cycles work. We have this inflated expectations at the top of the bubble, and then down to the trough of disillusionment, and then the slow slope of enlightenment, it's called, or slow development, a plateau after that, which happened in the dot-com bubble, but it took a long time to play out. And of course, what happens in a bubble is a lot of people invest near the peak of the bubble and then lose all their money as it deflates, thinking that it will go on forever. A lot of people join at that very last stage or in the last quarter of the bubble. Of course, you never know how big it's going to go, how long it's going to last. This reminds me just of a few years ago from 2020, 2021, we had stocks like ARK, ARKK, ARK Invest, which got into a huge bubble and then deflated, and a lot of investors joined as it was going up nearly at the top and lost their money. So even though now ARK, as the stock market has gone up again quite a lot this year, but of course most investors joined very late on in that bubble. At that time, there were various bubbles in various sectors, but it was kind of an emerging tech bubble. Of course, as I've mentioned, the EV sector was involved in that. Smaller EV companies that started up, people got very excited about that. There was market exuberance and people ended up losing a lot of money. Some of those have dropped 80 to 90% or more. There are quite a few sectors involved in that. Then in 2022, it deflated, but now it's gone up again. This year, it's had a resurgence because of AI, which after the deep decline in the market last year in 2022, up to 25% it was in the S&P 500. It's about 35% or more in the NASDAQ, but now these have recovered, and it's largely to do with AI, the excitement around AI, and who knows how high that bubble's going to go. Stanley Druckenmiller, as I pointed out in an earlier video, thinks it could go on for 2 or 3 years more. He's still invested in Nvidia, although he can change his mind in a week very quickly without telling people. And others like Mohnish Pabrai thinks that it is a big bubble like Microsoft was in the dot-com bubble days. He compares Nvidia now, the price that it is now, the exuberance around AI, to what Microsoft was like in the dot-com bubble. So Mohnish Pabrai's contention in this talk is that these bubbles seem to be 38 to 40 years apart, and there's a reason for that. It is that reasons that people forget. It's like a new generation who didn't experience the previous bubble, don't even necessarily know much about it. So if you were in the market back then, you remember and you take steps to not make the same mistakes again. If you remember the dot-com bubble, you might have seen the bubble happening in 2020 with emerging tech, and see the echoes there, see how it rhymes with that earlier bubble and maybe not participated so much. There were bubbles going on and SPACs and NFTs, and 2020 was just amazing for this group of bubbles that happened around innovation. There was a whole group of new investors in their 20s, early to late 20s, who got involved, who don't remember the dot-com bubble. They might know something about it, they might have seen things, but they, having not experienced it, they would have not really known. From 2020, after the pandemic happened, it did rhyme with the dot-com bubble. We had the Fed putting stimulus money in, and people had money to spare, and they're at home in the pandemic, being locked down and sort of gambling online. It was definitely sort of gambling thing. Some of the ridiculous things that happened with NFTs going into the millions all of a sudden. So people turned from sports betting to gambling in the market. We had the meme stock phenomenon, and companies took advantage of the SPAC boom. There were hundreds of SPACs that emerged. So all this happened during 2020 to 2021, and it did rhyme with the dot-com bubble for sure. Talking back in 2015, Mohnish estimates that because these bubbles seem to be 38 to 40 years apart, thought that 2040 might be the time for a big bubble. And as I've just mentioned, there have been bubbles in between. Of course, there was the financial crisis and the subprime housing bubble back in 2008 as well, but that wasn't a stock market bubble. Sometimes there are real estate bubbles, housing bubbles that can be different. In Japan, when they had their huge bubble that's taken more than 3 decades to recover from, that was unusual, very unusual, in that it was a stock market bubble and a real estate bubble at the same time, which is one of the reasons it was so big and has taken so long to recover from. Next, Mohnish points out that bubbles are actually very common, and even though he said there's this 38 to 40 year cycle of bubbles, there can be different kinds of bubbles building all the time, and he talks about the Nifty-Fifty Bubble now. In the late 1960s and early 70s, there was this group of 50 companies that was so popular and so big that you couldn't lose on them. It was thought that you could just put your money into them and no price was too high. It was a bubble formed around the biggest companies, the most popular companies. If we think of the FANG stocks today, these big tech companies, it would be companies like that, like Apple, like Microsoft. And there can be bubbles in stocks like that and companies like that, as we saw during the Nifty-50, which has been well forgotten, and younger people have no idea what that is. Unless you're interested in bubbles and you've read about it, you might not know about the Nifty-50, but it was quite a dramatic thing at the time. These big blue chip companies that people thought that they could not lose on. Companies like McDonald's, Kmart, Polaroid, Xerox, some of these have disappeared, but McDonald's is definitely still around. Mohnish makes the point that there was a slow motion crash of these stocks from about 73 to 74. One at a time they were taken out the back and shot, he says, when it was impossible to think that this could happen, but it was a bubble and they started to deflate over that time. And some of it was because of the macro environment at the time. There was a lot of doom and gloom around. There was the oil embargo. People were lined up at petrol stations, gas stations, if you're in the US. These things did affect the mood of the times, and it helped deflate the bubble. Mohnish says the economic times changed, as has happened recently when the Fed started to raise rates, and people think that wouldn't happen. Inflation went high and they started to raise rates, and that definitely affected technology stocks that were trading at very high multiples. People suddenly decided maybe these multiples are way too high when we're talking about 20 to 50 times sales on tech stocks that aren't making much money yet. And bam, look what happened. That's what deflated the bubble that time. I think it was a big part of it when there was 0 rates or very low rates, and then that suddenly changed. I'm going to put a link to a video up here and in the description for those not on YouTube about Mohnish Pabrai talking about the current bubble that he sees, the AI bubble. He's talked about that very recently. And up here, I'm going to put a video to Stanley Druckenmiller, who sees the bubble, but he's still invested in it. He's still invested in Nvidia. He says he thinks it's going to go on for 2 or 3 years yet. So go and watch one of those right now if you haven't already. And thanks for watching or listening, and I'll see you in the next one.